As President Trump's tariffs move from rhetoric to reality, two critical questions emerge. Will they trigger a recession? And can the Federal Reserve respond effectively if inflation remains elevated? The market's verdict so far has been pretty harsh. Stocks under pressure, consumer confidence at a 12-year low, and global allies preparing retaliatory measures. What are the investment implications of this seismic shift in trade policy? We're going to break that all down for you and a lot more right here on UBS Trending. Hi, everybody, and thank you so much for joining us. I'm Anthony Pastore, and this is UBS Trending. I am joined in the studio by Brian Levitt, Global Market Strategist with our partners at Invesco. Brian, great to have you in the studio with us.
Great to be here, Anthony. Thank you.
Good. We met up, recently, and we were talking a lot about potential tariffs, and now they've actually happened at this point in our story. And I don't have to tell our audience, we've seen some big, wild swings in both stocks and bonds when looking at treasuries, looking at where the yields have come and gone. Some days we've seen S&P 500 stocks up 3%, sometimes down 6%. So there's been a lot of volatility. So I guess the question is, when you think about Liberation Day, April 2nd, was it what you expected? Was it worse? Was it different? Was it better? I don't know if even those are the adjectives to describe, but what's your review of it?
Yeah, I did not think Liberation Day would be Escalation Day, right? If you remember when we spoke a few weeks ago, I was of the mind that let's just get past this, set the rates where you want to set them, provide some clarity to the market, and let's get past this. Now, unfortunately, we didn't accomplish either. We set rates at levels that really didn't make a lot of sense to people, given how they were calculated, and we still have the uncertainty around, well, are these negotiating tactics, or as Howard Lutnick says, these are the rates. And so, yeah, Liberation Day was not what I would have hoped for. And if you look at the chart we're showing, I mean, the average tariff rate now, if these do remain in effect, is higher than we've seen in a century, higher than what we saw during Smoot-Hawley with the Great Depression. Not to say we're having a depression, but just to say we were all taught the folly of the Smoot-Hawley tariff, and we're potentially repeating some of that here.
Right. Depression is obviously a big word. Since the Great Depression in the 1930s, there certainly have been regulatory curbs, halts, things that are available to the markets that weren't there. So it's,
none of us are lining up at the bank.
Pulling all our money
Pulling
out.
all our money out. The banking system's not over-levered. The economy's not over-levered. In fact, the setup for this year was almost as good as I could remember. Economy was resilient. Inflation was stable. Europe was stimulating the economy. So no, this is a self-inflicted challenge, not something that's bigger or more systemic right now in the economy.
Right. We're not even talking about subprime mortgage crisis from the 2008 and 9 great financial crisis. Right. So here's the thing, and I'm going back to the 2008 and 9 financial crisis. That's when my friends who are not in our business were suddenly asking me questions about, well, what's happening?
Yes.
And this is what's happening recently. What's happening and what should I do? So obviously I'm not a financial advisor. I say go talk to one.
Right.
But I can tell them the news, and I tell them what experts like you are talking about, because one of the things that keeps coming up is the inflation and then recession, which is look, if you look at some of the stats from Goldman Sachs and others, they're thinking 45, 50% chance of a potential recession. What do you think the bigger concern is? Is it lack of growth? Is it inflation? Are we talking stagflation, or have you gone to recession? What are your thoughts there?
Right now, so in the near term, it's both. So what you're going to look at is some demand destruction because businesses just don't have the confidence right now to put plans in place. Consumers are getting nervous given the volatility that you've referenced in markets, but you're also going to see prices increase in the short term. There's a back-of-the-envelope calculation for every 1% increase in the tariff rate, you get a 0.1% increase in inflation. So if you're starting at 2-something and you're taking tariffs up to 25%, you're adding 2-something to this. So you can see why inflation would go higher in the short term. Now, it's critical to watch the long-term inflation expectations if you want to get a sense of what the Fed is doing. So the chart you're looking at here is the more shorter term, where you see where the 6-month annualized year-over-year percent change in the personal consumption expenditure has been. I like the comfort zone. I like that we were at that higher end of the comfort zone. That's a good backdrop for nominal growth. Now we're starting to move above it. And so the momentum takes you up to call it 4% or so. But if you look at the inflation expectations, what you have is short-term, so that 3-year number going up, but long-term kind of curling over. So it's telling us in the short-term, weak growth, higher inflation, not ideal. In the longer term, inflation comes down because we become a lower growth economy. Not ideal, but not necessarily long-term stagflation. At least that's what the bond market is telling us. But that's a critical question.
Well, and by the way, let's talk a little bit about that, because we're looking at, obviously there were pretty wild swings in bonds as well. And when the tariffs were first announced, bonds seemed to be doing their job. They were rising while yields were declining. That's what bonds are there to do. They're a protection against the volatility on the equity side. So what are bonds telling you now?
So we've had a pretty big move lower in bonds. To your point, we went from 4.8 a handful of months ago down to 4%. We've seen a bounce in the last few days.
Right, and we're talking about the 10-year Treasury on that rate.
And we're all kind of scratching our head. Why did we go from 4 to 4.15 or 4.20? And some of that might be whiffs of stagflation, right? A little bit of inflation, and reassessing. Well, maybe the Fed's really not taking rates down to 3.5. The bigger issue, though, and worth thinking about, is this foreign investors telling us we don't understand your rules and we're not going to be sitting going forward on big boatloads of reserve currency because you're not going to be transacting with us as much, and we're going to start diversifying where we go. So a little bit of the irony in this is when you've heard for investors for years say, U.S. is going to lose the reserve currency, U.S. isn't going to be able to fund its debt. My response to that was, are you nuts? That would take a huge policy mistake. Now, I don't think that's where we're going. I think we'll still see negotiating tactics, but you're on the whim of the president right now. And so that's a little bit of a challenge. And it basically, we're calling into question right now, the markets are a bit higher inflation, less demand for U.S. Treasuries.
Right. Uncertainty remains, a big part of this ongoing story. And you can even see it when you look at the volatility index, the VIX. It's as we're sitting here, it's around 46, that 46 level. This is the second highest it's been since March 16th of 2020. Now, that was up at 85. But this is the second highest it's been since then. And so you can see that the volatility, and we might continue to see wild swings in the markets as this story unfolds, whether or not China retaliates harder, whether or not they come to the negotiating table. And I'm only pulling China out as one example because that was 54%
They're the most important example.
Most important. I mean, it's one of our hugest trading partners.
By far.
So this all comes into question then. What does Jay Powell, what does the FOMC, the Federal Reserve, need to do? Obviously, they're waiting to see, because they went from transitory in the kind of their rhetoric about the economic impact of tariffs to now, he just said in a press conference last week, more potentially persistent. So it seems like he's even saying we could see more persistent issues based on the economic kickback of the tariff situation and the ramifications.
But we know we'll get prices up in the near term. It's impossible. Yeah, it's inevitable not to. I mean, there's a cost to tariffs. You may decide that the tariffs are worth it if it's for national security or defending communities or industries, but there's a cost. Either the business has a lower corporate profitability, or the consumer pays for it, or both. So we know it's going up. It's going to be hard for the Fed to lower rates with the CPI or the core CPI moving towards 4%.
Right.
Good news is commodities are going lower. Services aren't going to be going up significantly. I think people are going to go to restaurants a little bit less, maybe fly a little bit less. So, but it's going to show up in the goods data. So what's the central bank to do? They're going to be a little bit more data dependent. It's critical that long-term inflation expectations stay below that 2.5%. At least if long-term inflation expectations don't get unanchored, then the Fed should be able to respond. But, what does it really do? I mean, I have a fixed rate mortgage. Do you?
So do I.
Yeah.
Since 2016.
Yeah. So what are lower rates really going to do?
There's something like I'm coming close to a number. It's like 10% of people who are mortgage owners have a rate that happened after 2022.
Yeah. Right, and so, I mean, it could help a bit, but it's not going to be the saving grace that it was during COVID or during the global financial crisis.
Right.
What Americans have gotten so used to is when you get into crisis, you're in that 10, 15% of the time where the markets are terrible, you want to be higher quality, and there's a rescue that happens. Mm-hmm. And usually it's either the Fed or the Congress coming forward with funds. We saw that in 08 and 2020. What we're dealing with now is, the Fed could lower rates. Maybe Congress provides some funds to farmers or other constituents who are being hurt by this. But economic policy uncertainty only peaks when we know what the trade conditions are going to look like. So It's a little bit of a different scenario. I don't want to get too negative because it can change on the whims of the White House, right? And so we don't want to run for the hills. We don't want to be all cash, but we probably want to be more value-oriented in the portfolio, bring down those elevated valuations, look at some international, just get those valuations down. Because if you go into a recession, the S&P 500 is not priced for a recession.
That's right. That's right. And we keep telling and reminding our viewers that you need to look into having a diversified portfolio, which is exactly what you were just saying, Brian. I know we're almost out of time. The question that keeps coming up now, and I'm sure you're getting this too, is when will we know if this is over? Now, clearly the news will dictate a lot of that to us. Will we have reconciliation? Will there be retaliation? And will we put the ink on the paper and sign it and we're done? But when will you know whether or not the market is bottoming, and when will we see perhaps the move to a more stable market coming out of this volatility?
There's a handful of indicators we watch. I mean, one of them is just the survey data of the American Association of Individual Investors, the bulls minus the bears. That's gotten quite weak. A VIX above 40 is usually a pretty good sign. Investment grade bond spreads moving back towards average. We're seeing that play out. The breadth of the market, what are the percentage of companies trading above their 200-day moving average, which has come down pretty significantly. So you're starting to see a lot, you can see it on this chart, the percent of stocks above their 200-day moving average down a lot. So you can see it starting to happen, put call ratio above 1, but you're going to need some policy clarity, right? I mean, it's all of these can flash, which is comforting. I mean, look, if you're going to have a recession, stocks go down 20, 25%. So we've probably done a lot of that. But, in order to move past this, you need better policy clarity. So we may be in a rough stretch here. It doesn't mean that, markets go substantially lower from here, but you may be in a rough stretch for a bit. The big risk is, I would say 1972 to mid-1980. I mean, people can look at that period and say, Brian, this is nothing like that period. Okay, yeah, there's significant differences between those periods, but that was a stagflation environment. And stagflation environment, you lost 8-9 years, call it a lost decade. You weren't negative in stocks, you lost a decade. And that's the thing we all desperately need to avoid, particularly given the ages of guys like you and me.
I'm looking down the barrel and figuring out when I can end this particular part of my life. But maybe we have to extend it a little bit. Working is a blessing. I say that every time I walk into this room.
This is fun. Who wouldn't want to do this?
Thank you, Brian.
My pleasure.
Another thing, obviously, that we're looking at is the hard data, right? We're looking at jobs, and jobs, we just got the jobs report recently, but it was backwards looking. It's from the middle of March. So we have to kind of see over the next couple months, what's that hard data going to look like, because it's a little bit regressive. So the Fed has a lot of, like you said, if they're going to remain data dependent, they've got a couple of months of data that they're going to really have to digest to figure out where we're headed. And maybe by then we'll have headlines that will confirm which direction we're going. Anyway, Brian, thank you very much. Always good to have you here, my friend. Good to see you. Thank you. And thanks, of course, to our great partners at Invesco. And for more information on anything that Brian and I talked about coming out of our great partners like them or our own Chief Investment Office, you can visit our Insights website at ubs.com/views. Plus, we're on social media. You can follow UBS on LinkedIn and Facebook as well as Instagram. Follow us at UBS Trending. Great content up there for you. And as always, if you have any questions about what Brian and I spoke about today, please make sure that you are continuing this conversation, especially these days with volatility, with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. We'll see you soon, everybody.